Hello friends, and welcome to Book Summary YT. I am your content strategist, and today we are going to talk about a major problem that almost every one of us faces who wants to grow their hard-earned money. Do you also want to invest the money earned from your 9-to-5 job and watch it grow? Do you also want to get rich from the stock market? But as soon as you start thinking about investing, your mind fills with thousands of questions. Which stock to buy? Is now the right time to put money in the market? Should I learn technical analysis, those charts and patterns? Or should I do fundamental analysis, read P/E ratios and balance sheets? The expert on TV says, buy this stock, while another expert says, sell it. In all this noise, what should a common person do? What if I told you that all these experts, all these tips, all this analysis, is mostly useless? What if I told you that trying to beat the market is like banging your head against a wall? And that the most successful way to get rich is the most boring way? Today, we bring you a summary of a book that has caused a stir in the investing world ever since it was first published in 1973. This is a classic book that has made millions of ordinary investors rich. The name of the book is A Random Walk Down Wall Street, and its author is Burton G. Malkiel. Malkiel, himself a renowned economist and investor, presents a very revolutionary idea in this book, that the stock market's movement is completely random. So, does this mean we shouldn't invest at all? Absolutely not. In this book, Malkiel not only tells us why it's nearly impossible to beat the market but also teaches us how you can build wealth without beating the market. So, if you are tired of this noise in the investing world and want to know a clean, straightforward, and effective strategy, then the next 20 minutes could change your financial life. Stay with us. Understanding A Random Walk Down Wall Street means shattering all your illusions about investing. This book by Burton Malkiel teaches us some very important lessons. We will understand it by dividing it into a few main parts. Part 1. The two amusing theories of investing. The author says there are two main methods of investing in the stock market that people chase. 1. The firm foundation theory. We also call this fundamental analysis. According to this theory, every stock, every company has an intrinsic value. This value depends on its earnings, its assets, and its future growth potential. Believers in this theory, like Warren Buffett, believe that sometimes the market, being emotional, sets a stock's price much lower or much higher than its intrinsic value. A fundamental analyst's job is to find that intrinsic value and buy a stock when it is available for cheaper than its intrinsic value. They believe that sooner or later, the market will realize its mistake and will raise the stock's price to its intrinsic value. The problem, Malkiel says this sounds great, but calculating the intrinsic value is very difficult. How can you accurately measure the future? How can you say how much a company will earn over the next 10 years? Different analysts calculate very different intrinsic values for the same company. 2. The castles in the air theory. We can also call this technical analysis or market psychology. According to this theory, it doesn't matter what a stock's intrinsic value is. What matters is how much people will be willing to pay for it in the future. This theory says that investing is a game where you have to guess what other people are thinking. You should buy the stock that other people are even more optimistic about than you are, so you can sell it to someone else at a higher price. Here, the price is driven by psychology, not fundamentals. Technical analysts do just this. They look at charts, find patterns like head and shoulders, and try to figure out which way the crowd is moving. The problem, Malkiel says this is like building castles in the air. It completely depends on whether you can find a greater fool who is willing to buy it from you at an even higher price. When the game of musical chairs stops, whoever is left standing loses everything. This is speculation, not investing. Part 2. What is the random walk? So if both of these theories don't work, what does? This is where the author presents his main theory, the random walk hypothesis. Malkiel says the stock market's movement is like a random walk. Imagine a drunk man walking down the street. Can you predict where his next step will land by looking at his previous steps? No. Similarly, a stock's price yesterday has no relation to its price today. Why? Because the market is efficient. This means that all available information is already included in the stock's price. As soon as any good news arrives, like the company's profit increased, millions of people immediately want to buy that stock, and its price rises in seconds. And as soon as any bad news arrives, the price falls. The news you are finding out today, like in the newspaper or on TV, is already known to big institutional investors, and the market has already reacted to it. So, the price will only change in the future when some new, unexpected news arrives. And because the very definition of new news is that it is unexpected, the market's movement is also unexpected, that is, random. Part 3. The proof, why experts fail. Malkiel doesn't just give theory, he also shows decades of data. He conducted a very amusing experiment. He asked his students to draw a fictional stock chart. Then he showed those charts to real, technical analysts. Those analysts found patterns, even in those fake charts, and gave buy and sell advice. The real proof. Malkiel shows that if you look at the data from the last 30 to 40 years, 80% to 90% of active mutual funds, meaning those funds run by genius managers, cannot even beat the market average in the long run. Yes, you heard that right. The experts you pay hefty fees to can't even give you the returns you would get from the average market. Why do they fail? Fees. These funds charge you an annual management fee of 1% to 2%. This is very high. Trading costs. These managers buy-sell a lot, which increases brokerage and tax expenses, eating into your returns. Randomness. The truth is, they cannot see the future either. So, the tip, or advice, you see on TV is mostly nonsense. Even if someone has beaten the market for 10 consecutive years, it could be luck, not skill. Part 4. So, what should the average investor do? This all sounds disappointing so far. If no one can beat the market, can we not make money at all? Malkiel says, you absolutely can. The solution is passive investing. If you can't beat the market, then join the market. This means invest in an index fund. What is an index fund? An index fund is a mutual fund that is not run by an expert manager. It just works like a computer program. This fund mimics a market index, like the Nifty 50 or Sensex 30 in India. For example, a Nifty 50 index fund will invest money in all 50 companies of the Nifty 50 in the exact same proportion. It doesn't use any brain. It just copies the index. What are its benefits? Extremely low fees, because it doesn't require a genius manager to run it. Its management fee-expense ratio is almost zero, meaning 0.1% or even less, whereas active funds charge 1.5% or 2%. Instant diversification. By buying one Nifty 50 index fund, you become an owner of India's 50 largest companies in one go. Your money doesn't depend on any single stock. Guaranteed market return. You will get the exact same return that the market, that is, the Nifty 50, gave. And as we've seen, this market return is better than the return of most experts. Malkiel's message is clear: stop trying to pick stocks. Don't try to find the needle, just buy the entire haystack. Part 5. Your biggest enemy, you. Malkiel says your biggest enemy in investing isn't an expert or the market. It is you, yourself. Our human brain is just not built for investing. Greed and fear. When the market is going up, we get greedy and buy at high prices, herd mentality. When the market is falling, we get scared and sell everything and run away, panic selling. We buy high, sell low, which is the opposite formula for getting rich. Overconfidence. We think we know everything. We think we will find the next multi-bagger. This overconfidence makes us trade more, which only benefits the broker. Aversion to loss. Research shows that the pain of losing 1,000 rupees is twice as strong as the pleasure of gaining 1,000 rupees. Therefore, we hold on to our losing stocks, hoping they will come back up, and we sell our winning stocks too quickly. The solution: keep your emotions away from investing. Part 6. Practical action plan. Okay, so we've accepted that we need to invest passively in index funds. But how to do it? How much? Where? Malkiel provides a life cycle guide for this too. Rule 1. Start early. The most important thing in investing is time. This is because of the power of compounding. For example, if you start investing 5,000 rupees every month at the age of 25, at a 12% annual return, by the age of 60, you will have 5.3 crore 53 million rupees. But if you delay by 10 years and start at 35, with the same 5,000 rupees per month, by age 60, you will only have 1.5 crore 15 million rupees. That 10-year delay cost you almost 4 crore 40 million rupees. So, start today. Rule 2. Asset allocation. This is the most important decision. Asset allocation means where you divide your money. There are two main places: equity or stocks, high risk, high return; debt or bonds, low risk, low return. Malkiel gives a simple formula. Keep the percentage of money equal to your age in debt or bonds. If you are 25 years old, keep 25% of your money in debt and 75% in an equity index fund. If you are 60 years old, keep 60% in debt and 40% in equity. Why? Because when you are young, you can take risks. You have time to withstand the market's ups and downs. When you are older, you need safety and regular income from your money. Rule 3. Dollar cost averaging, i.e., SIP. Don't try to time the market, meaning don't think about when is the right time to invest. Instead, take the path of SIP, systematic investment plan. Decide that you will put 10,000 rupees into an index fund on the 5th of every month. That's it. When the market is expensive, you will get fewer units. When the market is cheap fallen, you will get more units for the same 10,000 rupees. In the long run, your average cost decreases and you are saved from making emotional mistakes. Rule 4. Rebalancing. Once a year, look at your portfolio. Let's say you are 30 years old, and your plan was 70% equity, 30% debt. But this year, the equity market did very well, and now your portfolio is 80% equity and 20% debt. Rebalancing means you sell the 10% equity that has grown and put it into debt, so you are back to 70 to 30. This forces you to book profit and buy the cheaper asset. Conclusion. So, what is the essence of A Random Walk Down Wall Street? Burton Malkiel isn't telling us that getting rich is impossible. He's just saying, don't fall into the trap of getting rich quickly. Stop trying to beat the market. That is gambling. Ignore experts and tips. Invest most of your money in low-cost, broad market index funds. Start early and invest regularly. SIP. Asset allocate according to your age. And most importantly, be patient. Investing should be boring. If your investing is exciting you are probably speculating. Don't leave your hard-earned money to a random walk. Grow it through a disciplined plan. So, this was the summary of Burton Malkiel's classic book, A Random Walk Down Wall Street. I hope you understood how you can build wealth with a simple and powerful strategy, without any tips. If you liked this video and learned something new, please like this video. Share it with your friends and family, especially with those who are confused about the stock market. How did you like this book? Or which book do you want a summary of next? Do let us know by commenting below. And yes, if you don't want to miss such informative book summaries, don't forget to subscribe to the Book Summary YT channel and also press the bell icon. Thanks for watching. See you in the next video.